Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business. Today, we're diving into the LGL Group's latest quarterly report. It's like trying to read a secret message written in accounting, but don't worry, we'll break it down together. Get ready for some numbers that might make your head spin and a few insights that hopefully won't. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community link in the description below, so check it out. So what's the story? LGL Group, a company with its fingers in services, investments and manufacturing, just released its Form 10Q. Think of it as a report card for the first 3 months of the year. The headline, a slight dip in profits despite a revenue bump. Is this a cause for concern or just a minor speed bump on the road to success? Let's find out. First up, let's peek at the condensed consolidated balance sheets. It's like a snapshot of the company's assets and debts. We can see that as of March 31st, 2025, they have about $306,000 in accounts receivable. Those are basically IOUs from their customers, compared to the end of last year, December 31st, 2024, which was about $493,000. Dollar Gen Volatility 1 through How to Read in Dollar Steer, December 31st, 2024, which was about $493,000. It looks like people are paying them faster. That's good news. Now for the less cheerful part, let's look at their total LGL Group stockholders' equity. We are talking about the amount of money that the owners have in the company. It's roughly $39,233,000 as of March. But if we look at a row below, we also see something called accumulated deficit. It's at about $6,684,000, meaning they still haven't recovered from previous losses. Think of it as a past due debt. Moving on to the condensed consolidated statements of operations. This is where we see how much money they're bringing in and how much they're spending. Total revenues increased slightly, but let's focus on net sales, which is at $498,000 for this quarter, up from $392,000 in the same period last year. That's good. Sales are increasing. But looking a little below, we can also see that total expenses also increased. So while they are bringing in more money, they are also spending more to do so. It's at about $877,000 compared to $809,000 last year. If we look at the net income, the number is down to $13,000 from $43,000 a year ago. Finally, let's jump to one of the last important figures. We can see that loss income per common share attributable to LGL Group common stockholders is negative for this quarter. This means that their investors are not seeing profits. This is happening because of all the previous reasons. They had more expenses than revenue, so it comes as no surprise. On the other hand, the weighted average shares outstanding is roughly the same as last year, so they aren't issuing more stock and devaluing the existing ones. The filing divides the company into two segments, electronic instruments and merchant investment. Electronic instruments includes the products PTF makes and sells, which are precision timing devices. The merchant investment side is all about Lynch Capital, the business they use to make strategic investments. Think of it as their venture capital arm. The report shows the results in each segment. The revenues, net sales for electronic instruments were at about $498,000. Merchant investment instead has a different number, that being net investment income at $247,000. After that, it mentions a third segment called corporate that has revenues, but it's mostly related to balance allocations for internal accounting purposes. If we scroll down to the tables below, we can see that the electronic instruments segment had $19,000 in profit, while the merchant investment segment had $153,000 profit. The corporate segment had a loss. This highlights the profitability differences between their two main areas. Next, the filing dives into some fair value measurements. This is about how they determine the worth of their assets. It mentions that they use different valuation methods, such as looking at market prices or estimating future cash flows. It is a common section that usually states if their evaluation has changed, but in this report, they're consistent with the previous one. The company also touches on related party transactions. These are with companies that might have some sort of connection to the LGL Group, such as shared ownership or management. We can see their revenue coming from those related companies like Mtron Industries is fairly consistent with previous years. Finally, the filing details how they compensate employees with stock, what we call equity. There are specific values and amounts, but the story remains the same. The LGL Group grants shares to its employees in return for their services, with the goal of aligning management's interests with the company's success. Now let's step back and look at the big picture. LGL Group has some positives, like rising sales in their electronic instruments segment. The merchant investment segment also keeps pumping out profits, which gives them the ability to keep experimenting. But their rising expenses and the persistent accumulated deficit is a cause for concern. They are very far from being out of the woods, as the expression goes. The direction of the company depends on a few things. First, they have to keep those sales numbers up in the electronic instrument side and maybe even release new products. And second, they need to control those expenses and reduce that accumulated deficit, because while it might not seem like a big number, it means that they're nowhere near being safe. Also, you have to keep in mind that the numbers here are for Q1. This means that things might swing wildly in either direction during the rest of the year. As it stands, the LGL Group feels like a ship that's slowly turning around. It's not sinking, but it's not exactly sailing smoothly into clear waters either. Alright, that's our breakdown of LGL Group's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.